What's going on, everybody? This is Coach Wade, and today I want to talk about one of my favorite investing strategies, the power of dollar cost averaging. Now, have you ever wondered, should I invest now? Or what if I invest today and the market goes down tomorrow? You're asking the same questions that millions of investors ask. The good news is there's a simple strategy that can help take a lot of the emotion out of investing. It's called dollar cost averaging. Now, don't let the name intimidate you. The idea is actually very simple. Dollar cost averaging means you invest a fixed amount of money on a regular schedule, regardless of whether the market is up or down. For example, let's say you've decided to invest $300 every month toward retirement. You invest that $300 this month, you invest another $300 next month, and another $300 the month after that. You keep investing whether the market is having a great year or a difficult one. The amount you invest stays the same. Now, here's why this strategy is so powerful. When stock prices are higher, your $300 buys fewer shares. When stock prices are lower, that same $300 buys more shares. Think about that for a moment. When investments become less expensive, you're able to buy more ownership with the same amount of money. That's exactly how shopping works. If your favorite store has a sale, most people get excited. They can buy more of the same for the same amount of money. But something interesting happens when it comes to investing. When the market goes on sale, many people panic. Instead of buying, they stop investing, or worse, they sell. Dollar cost averaging helps remove that emotional decision making. Instead of asking, should I invest this month? The answer is already built into your plan. Yes, you keep investing, whether the market is up, whether the market is down, whether the financial news is optimistic, or whether the headlines seem scary. You remain consistent. One of the biggest mistakes new investors make is waiting for the perfect time to invest. They'll say, I'm waiting for the market to come down. Then the market comes down, and they become afraid. So they wait even longer. Then the market starts going back up. And now they're waiting for it to come back down again. Before they know it, years have passed, and they still haven't started investing. Dollar cost averaging helps solve that problem. It shifts your focus away from trying to predict the market and toward consistently participating in the market. Now, let me be clear about something. Dollar cost averaging doesn't guarantee you'll make money, and it doesn't protect you from losses during market declines. Every investment involves risk. The value of investments can go up or down, but what this strategy can do is help create discipline. And discipline is one of the greatest wealth building habits you can develop. As I teach in the 7 stages to financial independence, investing becomes a priority during stage 4, the wealth building zone. By the time you reach stage 4, you've already built your emergency fund. You've eliminated your consumer debt. You've established financial security. Now it's time to consistently invest for your future. I encourage people to work toward investing 15% of the household income for retirement. Not because I'm trying to predict what the market will do next month, but because consistency over decades has historically been one of the most effective ways to build wealth. Think about it this way. Imagine trying to lose weight. Would you rather exercise once for 10 hours or exercise consistently for 30 minutes several times each week? Most people know the answer. Consistency beats occasional bursts of effort. Investing works much the same way. One large investment isn't necessarily what builds wealth. It's the habit of showing up month after month, year after year, and continuing to invest. Here's another benefit of dollar cost averaging. It helps remove emotions from your financial decisions. You're no longer chasing excitement when the market is booming, and you're not running away when the market becomes uncomfortable. You're simply following your plan. Successful investing isn't about being emotional, it's about being disciplined. It's about making decisions before emotions have a chance to interfere. Now, here's what I want you to remember. The goal of investing isn't to buy at the absolute lowest price. Very few people can consistently do that. The goal is to build wealth over time. Dollar cost averaging helps you stay focused on what really matters: long-term consistency. Because wealth isn't usually built through perfect timing. It's built through faithful investing, one paycheck at a time, one contribution at a time, 1 month at a time, and 1 year at a time. I'm Coach Wade, and I believe that successful investing doesn't have to be complicated. You don't have to predict the future. You don't have to guess where the market is headed next. You simply need a solid plan, the discipline to stay consistent, and the patience to let time work in your favor. Because in the end, the investors who build lasting wealth usually aren't the ones who are the smartest. They're the ones who remain consistent. Stay the course. Keep investing. And until we meet again, this is Coach Wade. Take care.